Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by AllSpring Global Investments. As such, the sponsor may suggest topics for discussion, but the final control remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Henrietta Pacquement, who is the head of Global Fixed Income Team at AllSpring Global Investments, formerly known as Wells Fargo Asset Management. Henrietta, welcome to the show.
Hello, thank you for having me.
So, can you tell me a little bit about your background and how you got into investing? I noticed that in your bio it says you studied astrophysics at Cambridge University. How do you go from that to investing, and what was sort of your focus?
Well, I like technical things. I like to understand how things work. So I think that's what got me into astrophysics at university. And then the attraction of going to work in the financial markets was to get that understanding, but of the world at large. So I think that was the transition. So I started work at AXA Investment Managers a few years ago now, before moving to BGI and where I am now. So I've always been in the fixed income markets and gradually gravitated more to the credit side, where I am today.
But it's quite a difference between astrophysics and investing. Is there any overlap other than sort of maths behind it?
Oh, maths, definitely. Curiosity, definitely. Having to sort of look around you and figure out how things work and how the news that you get, you have that exercise of interpreting it and then expressing it in your portfolios. And I think that's really what I enjoy.
Yeah, excellent. So, I mean, a lot of focus today is on inflation, and we hear about stagflation, we hear a little bit about future maybe disinflation. Where do you sit on that picture? Are you concerned about this? Do you think it will drag out a long time?
It's definitely a big topic, and what we've seen in the markets, even in the last couple of days, in terms of movements on the interest rate side and what the central banks are doing, it is the focus at the moment. Now, different geographies have got different drivers, I would argue. If you look at the US, you've got a very strong consumer, and that's what the Fed is trying to calm down at this point in time. If you look at Europe, slightly different. We're clearly closer to the conflict in Eastern Europe. As a result, energy is really the driver in terms of inflation there. So the central banks have made it clear this week, we've had another number of them move, that this is what their focus is. And if they have to sacrifice growth in the process, they're going to do it. So I think that really has been the message this week.
Yeah, so to what degree are you concerned about recessions? Because I think when we look at the US, the chair of the Fed, Jerome Powell, has already said that, you know, the bigger mistake would be to not get inflation under control. So he almost flagged that he's fine with a recession or two. How do you see that?
I think it is what they're trying to address at the moment, and to an extent, if you look at the tools that they have, they're reasonably blunt. Right, we're talking about moving your short rates. We're talking about tightening your financial conditions, and that takes time to sort of filter through in a first instance to the economy, to slow down the economy, and then it'll impact inflation. So you've got that sort of staged process. And at the moment, they're trying to see, well, how much do they need? And we need to see a bit more color in terms of the economy. We need to see how that's sort of filtering down. So they've been hiking for a little while now, so we should start to see economic impact, and it should at some point filter into the inflation numbers as well.
Yeah. How much grasp do you think central banks have on inflation? Because I understand that inflation is actually quite a difficult concept to sort of deal with, because there is an element of behavior in there as well, that, you know, once prices go up, then people react to that, and even though that pressure they might get rid of that pressure, that behavioral aspect is still there.
And that's what they're trying to break. What they want to address is the persistency element. So dial back about a year, we were talking about transitory inflation. And the fact that it was going to be coming out of COVID, a bit of enthusiasm in terms of the consumer, getting out, exploring all the services that they couldn't do for the past year and a half or 2 years. So we've seen that. Then you actually had the hit on the energy side, which the central banks didn't necessarily anticipate, but has impacted pricing in the economy. And yes, you've had these sort of shocks, one after the other in short succession, which has embedded the discussion around pricing and rising prices a little more in the economy. So I think that's really what the central banks are looking to address. And you're starting to see, as you say, a bit of a wave. So you have your energy prices going up. Then you have your services going up because you have to pay for energy and so on. So you've got this sort of waterfall effect that we're seeing at this point in time, and a broadening of increases in prices. That's what they're looking to address, and they don't want it to embed. That being said, what's interesting to see is wages, right? What they really don't want to have is a sort of spiral where you have rising prices and rising wages, and that's really when inflation becomes more destructive. At the moment, still, on the wage front, we're seeing some rises, but not as much as inflation. So that's a silver lining, if there is one.
Yeah. Now, you look mostly after the European market. What are some of the differences that you see there compared to, say, the US market?
So I mentioned one of those. Clearly inflation pressures due to energy, and to a lesser extent food, but are more pronounced, I would say, on the European side. And the Europeans have been reacting to that. And there's a degree of can kicking into 2023 to try and sort of smooth the process for the consumer. And if you look at the UK, also businesses as well, with a business package coming out there. So I think that's one of the differences. Also, I would say that growth is less strong, tends to be less strong than in the US, and I think the pricings that we're seeing there are reflective of that, be it in terms of credit spreads, be it in terms of rates at this point, and the behavior of the currency. So a lot of that sort of growth potential differential is in the price. In the US, as I said, strong consumer, and that's really what the Fed is trying to address. Now, we are starting to see some cracks, which is probably a good thing. If you look at the housing market and the activity in the housing market, that has taken a bit of a turn down. We'll have to see what happens in terms of pricing, but that's the kind of thing that they would like to see at this point.
Yeah. So how does that sort of translate into your portfolio settings? Are you a bit more conservative in your allocations?
I think given the volatility that we've got in the market at the moment, it's tough to make some very pronounced calls. So I think that's one element. If we look at the portfolios, we've got a slight underweight on our interest rate side, in our credit portfolios in particular. At this point, we're probably looking to close that, given the moves that we've seen, to sort of have a pause for thought and see what comes next. We do have a bit of an overweight in terms of credit spreads. We are starting to like the kind of spreads that we're seeing, particularly on the investment grade side, where we're looking at companies that are larger, that have got more flexibility, that are better rated. I think that makes sense there within reason. Still not too keen on credit duration. I think we'll have to see how that evolves. And we're seeing an active primary market. There has been less issuance this year in on the credit side of things, and what issues are coming now are tending to come with a bit of a premium, some interesting spreads. We've got dry powder at the moment, so we're using some of that in the primary markets.
Okay. So when we look at the market in fixed income, the sort of the bigger events tend to play more of a role than probably in the equity market. And we see a couple of major things happening in Europe at the moment. You mentioned the war in Ukraine. How does things like that translate into investment decisions?
It's been, quite a start to the year. Yes, the conflict in Ukraine has had a number of effects. I think one that's maybe less obvious and something that we've been careful to manage in the portfolios is the effect on utilities. Because of the various sort of hedging mechanisms and so on, that is a sector that's been seriously under pressure, and to the point where we've seen government intervention and sovereigns taking over some of the institutions on the utility side, be it in Germany more recently and in France. So I think that's an area where, for instance, we're underweight in our portfolios, with the expectation that we're going to get plenty of issuance on the utilities side to fund their situation at the moment, but also actually to fund the transition from a climate perspective. So we're expecting them to come to the market, and they're going to have to pay up when they come.
Yeah, the conflict in Ukraine and sort of the broader geopolitical tensions have been sort of more of a recent topic, but we've seen a lot more attention recently for the energy transition that you just mentioned. How does that come into play on the credit side? There's obviously an expectation that there needs to be a lot of investment in this space to change the infrastructure, to have new technologies. How does that translate on the credit side for opportunities?
So it's been really interesting. I mean, there's been a lot done already to portfolios on the equity side, but I think if you look at asset owners, they're looking to broaden the scope of what they're doing from a climate transition perspective. And one of the next candidates is fixed income and credit in particular, and looking at their portfolios to see how they can meet, in some cases, their alignment targets. More and more institutions are looking at that and committing in various forms to net zero over the next few years, and they have to look at that on their entire portfolios, and that includes fixed income. So we're seeing a lot of interest there, a lot of figuring out how to align portfolios on the credit side, and we're also seeing a lot of innovation on the market side and what's available in terms of green bonds, transition bonds, sustainability-linked bonds. It's an area where we're seeing a lot of innovation, and it is becoming a topic for issuers. So when we meet them, when they come to market, they will address questions around the transition and what their strategies are going forwards. So very much a hot topic and is driving investment decisions and repositionings of portfolios at the moment.
Yeah, and from what I understand, if you look sort of the history of addressing environmental issues, then there's sort of a long history on the equity side. But on the credit side, you can be more specific because of the instruments that have been issued. Does that help you sort of position the portfolio?
Absolutely. I think there's a richness in the credit markets that really lends itself well to that kind of thing, because you can look at the use of proceeds, you look at the subsidiaries that you invest in, particularly for larger investment grade conglomerates. They can have very different areas of their business that you can go and target when investing in them. So I think that's one of the areas where you have to do your homework and sort of go and explore what is available. But yes, a lot of opportunity to go and fund specific projects, specific transformation at an issuer level.
With the war in Ukraine, there's been obviously sort of a disturbance in the energy market. Prices have risen for more fossil fuels. Do you think that has put a bit of a pause on investments from company into the transition because they see that it can be quite volatile in the meantime?
I think it's been a very interesting experiment under terrible circumstances, and you'd have never wanted to have a situation arise as it has. However, I think it does bring a lot of learning points to how we need to think about the transition in years to come. Essentially, we've been given a bit of an example of what it would look like if we had to go cold turkey in terms of fossil fuels, and the answer isn't a pretty one. We're not ready for that. So it is a question of having a very thoughtful approach to evolving business models over time on the corporates themselves, and indeed in terms of funding the transition going forwards. I think you have to sort of think about how fossil fuel providers, energy providers are going to participate in the transition, because we believe that they need to participate in that transition. We need to see and plan the electrification of the grid, which is going to have a big impact in terms of decarbonisation. As a result, you have to think about your metals and miners and how they're going to be contributing. If you're electrifying your economy, guess what? You need some copper. How does that work? How do you get that going? So I think it's been an opportunity to really highlight the challenges of the transition, how it needs to be thought about over years, not just sort of over the next few weeks, next few months. And it's a process. It's going to be a process, and we need to facilitate that as asset owners and asset managers.
Yeah. So this is a very long-term sort of transition.
Correct.
Does that also influence credit on the duration side? I mean, do you see sort of longer issuance associated with transition themes?
Yes. I mean, if you look at some of it is linked to transition, some of it is linked to the sort of style of projects. So yes, if you look at where different industries tend to issue in terms of maturities, if you look at your cyclical sectors, I'm thinking autos, for instance, that'll be on the sort of shorter end of the spectrum, because investors need to have a bit of visibility. The auto sectors need to have a bit of visibility, so you would expect them to be on the sort of short to medium term. As soon as you start talking about utilities, yes, they are prime candidates for issuing on the longer end, and we see issuance in that space from them. So yes, there is a degree of that maturity coming in, and it's also interesting to see some of the features of the bonds that are coming out, and we're starting to see some financial penalties come into coupon levels if certain metrics aren't respected, be it from an ESG perspective, or be it from a climate perspective. And that's an interesting one, because you have to measure those impacts, and those impacts are going to take a few years to get going. So you might be looking at setups maybe a year before the maturity of the bond. Does that make a big difference? I think the jury's out on that one.
Yeah. So these measurements and these penalties, how easy is it to get your head around it in terms of, if we look at ESG research in itself, that there's a lot of different standards. There's not really a lot of general consensus around it. How does that work with sort of the measurements of these bonds? Is there a set framework, or do you have to develop your own in that?
So maybe tackling it two different ways. I think there's certain subjects that are easier to get one's hand around. Climate, I would argue, is one of those. Big challenge for the economy, but actually we've got quite a defined objective that we're looking to aim for. I think broad ESG, as you say, there are a lot of topics. There are a lot of efforts, be it on the environmental side, be it on the social side. Governance, I would argue, is something a bit more traditional, and where one company is more likely to pay back its debt, its coupons, its principal, which is, as a bondholder, what I like to see. So I think that's something that both investors and issuers are more used to dealing with. The other two, I think, we are seeing more standardization in terms of disclosures, primarily driven by regulation. I think that is a sort of sensitive topic, so that there's a better disclosure and investors have got a better idea of actually what is being addressed. We've seen that definitely on the European side. We're going to see more of that coming our way in 2023, and we've got the SEC as well, starting to sort of formalize what they want to see as well. So, and companies are responding, asset managers are responding as well. So the amount of data is increasing. But I would say it's for the asset managers, the asset owners to have a look at that and see how they can best use it. And we've certainly developed our own views from a climate perspective. We've got a framework that we've developed so that we have a real common sense understanding of what a company is looking to achieve from a climate perspective, which allows us to get a better handle on what it's going to mean in terms of decarbonization for them, what it means in terms of fundamentals as well for a company there. And on the ESG front, same thing, so that we've got a homogeneous understanding of the topics that we want to focus on.
Yeah, and so sort of related to this topic of measurements, some of the funds that we speak to, they're getting more and more concerned about greenwashing.
Absolutely.
And we did something recently where one of the asset owners almost lamented, said, all the funds that were last year infrastructure funds are now climate transition funds. What is going on here? How do you avoid sort of buying into greenwashing bonds?
I think disclosure is really the way out of that, and also doing your research, understanding what you're investing in. There's only so much the metrics are going to give you. You need to have that sort of holistic approach and sort of say, look, what is it that they're trying to do? How are they implementing it? What's the governance around the element from a climate perspective, for instance, that they're looking to engage in? So it's getting that understanding, it's getting that and making it timely. You have to keep up with the changes that are going on and what companies are doing. It's changing fast. It's in some cases changing a lot. So you have to keep on top of it. And then it's being able to explain what you're doing and to sort of say, look, it can be quite a nuanced choice at some point, investing in a company or not. But I think the importance is to say, look, this is why we've done it. These are the criteria we look at. This is our selection process, and hence this is why it's in your portfolio.
Yeah.
And we are looking to address this element of sustainability.
Yeah. Can you tell me a little bit about sort of the innovation that takes place in this space? Because we've seen the rise of green bonds, but not every green bond is the same. Can you tell me a little bit about that?
Yeah, absolutely. So seeing a number of types of bonds now that are being explored, and I'm going to say explored because I think some have got a future, some may not have a future. I think there is some innovation that we need to see what's going to work for issuers and what's going to work for investors as well. I think the green bond space is becoming a bit more standardized. We've got a bit more history. It's something that we've seen before. You're starting to see rules around the definition of green bonds, also the validation of the parameters that they are in terms of use of proceeds with various organizations affirming the sort of labels from a green bond perspective. So I think we're gradually seeing more standardization there. And we have had cases of bonds that have been downgraded and that have been excluded from or stripped of their green characteristics. So I think there'll be more attention on the issuer side to make sure that doesn't happen, because I think from a reputation perspective for them, it doesn't look good. And also there's an education on the asset owner's side to sort of say, okay, well, this makes sense or not. And then some of the innovation in terms of other styles of bonds are because some organizations aren't necessarily going to have enough to be able to create a green bond package. So I think some of the innovation there is interesting to sort of broaden the appeal, broaden the sort of types of funding that a company can access depending on their size, depending on their activity, and so on. And I think that's really what's driving the innovation we're seeing.
So when we look at sort of issuance related to this theme of the energy transition, is it all about, utilities trying to transition, or are there other sectors that might not necessarily be obvious?
Well, we all need to do that. And we were talking about the consequences of the unrest in Ukraine. There is not a time where we listen to the radio or TV in Europe where we don't get tips about how to use less energy, how to use less gas, and how to change our habits in terms of energy consumption. So individuals and households need to participate, and that means looking at real estate companies. How do you look at the insulation of your real estate park and so on? So it impacts that area as well. We talked about metals and miners and how they come into we're going to need metals for this transition. How do they fit in? Building material providers. CO2 is a byproduct of making cement. How's that going to evolve? That is definitely one of the sort of harder to abate sectors from a climate perspective. If you look at, obviously, your utilities, big thing, but auto companies, we've got a bit of a clearer path as to what they're trying to do in terms of electrification. It really touches our day-to-day life across the board. That's why it's so hard.
Yeah. Is there on the other side also, there's a lot of opportunity with the transition as well for investment and for credit. Do you also have a credit that is no longer sort of interesting or that you don't want to touch anymore?
You always have some of those. At this point, two things. One, we are heading towards a more difficult economic environment. So I think security selection in that sense is key at the moment. We've probably sort of seen peak fundamentals in terms of companies' balance sheets. I would say that they're coming into us in good shape, courtesy of all the efforts that have happened over the COVID period. The fact that companies have been also funding, so the sort of funding wall, as it were, has been pushed back to call it 2024 or 2025. That's helpful, but it is going to be a more challenging environment. So I think we're definitely looking for companies that have got balance sheets that can take the hit. So that would be one area to focus on. And then, yes, I think that in terms of transition, there's some business models that are either lagging or not making the effort or just hoping it's going to go away. That's going to get harder and harder.
Yeah. So if we get into that more difficult environment, I suppose one of the key concerns for you is sort of increasing rate of defaults. Are you already seeing some of that, or is it still at sort of more historical levels?
We're seeing more companies that are trading at distressed levels, which is usually a sign that defaults may pick up. I also think that you've had some of the support mechanisms that you've had in recent years, be it the sort of central bank put, be it also some of the sponsors coming in to retain ownership of a company because they've been in sort of yield-seeking behavior given low rates. I think that has changed. So that's what we need to be a little careful about. So some of the companies that are now trading at distressed levels are not going to make it.
Yeah. Are there more opportunities as well in the distressed space? Are you investing in that?
I've got colleagues who are investing in the distressed space because we're looking primarily on our side at sort of higher quality portfolios. That's not necessarily our hunting ground, but yes, I'm sure there are some opportunities on the distressed side that are coming up. I mean, one has to realize if you look at spread levels now, if you look at high yield, for instance, in sterling, you're close to 10%. At an index level. If you look at the US, you're in the sort of mid 8%, and a little lower on the European side. These are starting to be interesting levels from a spread perspective. Volatility going forward, yes, but if you've got the patience, it's more likely to sort of generate returns in the next sort of 6 to 12 months.
Those broader spread levels. Does that also mean that it becomes a bit more interesting to go longer duration?
Longer duration, we'll start going neutral first in our case on the credit side, and then we might explore. I think we're trying to sort of see a few more signs of the economy rolling over before doing that on our credit portfolios. There are some signs, and if you look at sort of consumer confidence, for instance, in various geographies, we're sort of hitting new lows. So that sort of illustrates some of the what might be coming our way. But we were talking about it this morning. If you look at the sort of short end of the US curve, and you're around 4%, for 2 years, that doesn't look bad.
Yeah, for sure. So I think this is one of the first podcasts that I've done face-to-face again after many years of doing Zoom podcasts. So thank you for coming to the office. And you're here in Australia to talk to some of your clients as well. What sort of questions are they asking you about the current environment?
So one of the big real discussion points we've had over the course of this week has been around how to implement climate considerations in fixed income portfolios. I think that really seems to be one of the big focuses of longer term institutional money in the Australia and New Zealand region. So it's been really interesting to see where asset owners are in terms of their journey, but it feels as if this is a real focus. Having dealt with their equity portfolios, the turn now is on the fixed income side. So we've had questions around how to think about it in fixed income. We've had questions about how to implement it, how to measure it in fixed income. Also how to have a balanced approach between maybe not sort of overdoing it on the exclusion side, because that's quite a blunt instrument, but focusing more on the engagement with companies, be it in terms of understanding their strategy and then keeping track of what they're doing in terms of their climate transformation. So that engagement element also coming up a lot in the discussions.
Yeah, I think the transition is probably one of the main trends and main topics going forward as well for investing, and we probably won't have seen the end of it yet. It will be a big theme going forward. But Henrietta, thank you very much for coming to our studio and talk about this, and thank you for your time.
Thank you very much for having me on the show.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.